Options on futures. Same structure as stock options, completely different rules underneath. Here's what actually matters.
An option on a futures contract is exactly what it sounds like. An option whose underlying is a futures contract, not a stock. The buyer of a call pays a premium for the right, not the obligation, to go long the futures at the strike. The buyer of a put pays for the right to go short. The seller collects the premium and takes the other side. Standard option structure. The twist is what shows up in your account after exercise. Not 100 shares, not a cash settlement, a live futures position at the strike, which you can close, hold, or roll. And that one detail, that you end up holding futures, rewrites the margin math, the tax math, and the risk math in ways stock options traders don't see coming, including one rule that can realize a loss on December 31st whether you close the position or not. We'll come back to that. The product universe is concentrated. Most U.S. options on futures are listed on the CME. Equity indices, FX, metals, energy, ags, interest rates, even crypto. ICE handles softs and Brent. Eurex covers European rates and indices. If you're trading retail, you're almost certainly on CME. So how does this differ from the equity options you already know? 4 things matter. First, the multiplier is set per product, not 100 shares. One E-mini S&P option controls $50 per index point. One WTI crude option controls 1,000 barrels. Get this wrong and your position size is off by an order of magnitude. Second, margining runs on SPAN, CME's portfolio-aware algorithm, not Regulation T. We'll get to why that matters. Third, taxes. In the US, options on futures fall under Section 1256. That means 60% long-term, 40% short-term capital gains treatment, regardless of how long you held. Hold for 10 minutes, still 60-40. For an active trader in a high tax bracket, that's real money. But it comes with a catch. Section 1256 contracts are marked to market every December 31st. Open positions realize P&L for tax purposes whether or not you close them. And fourth, expiry style. Mostly American on CME, but always check the product spec. Here's what that looks like on a real trade. December E-mini S&P futures are trading at 5,000. You think the index rallies over the next month, but you want to cap your downside. You buy one ES 50/50 call, 30 days to expiry. Premium is 30 index points. At $50 per point, that's $1,500 out the door. Your break even at expiry is the strike plus the premium. 5,050 plus 30, so 5,080. 3 scenarios. ES settles at 51.50. Your call is 100 points in the money. You exercise into a long futures position at 5,050, immediately close at 51.50, pocket $5,000 gross. Net of premium plus $3,500. ES settles at 50.50, call expires at the money. You lose the $1,500 premium. ES drops to 4,900, call expires worthless. Same $1,500 loss. Now compare that to just going long one ES futures contract at 5,000. If the index rallies to 51.50, you make $7,500 on futures versus $3,500 on the call. The call gave up upside, but if the index drops to 4,900, the futures lose $5,000 while the call lost $1,500. That's the trade, cap downside in exchange for capped upside. Which brings us to why these instruments exist in the first place, and it wasn't speculation. The original use case was commercial hedging. Take a wheat farmer expecting to harvest 10,000 bushels in 3 months. CBOT wheat futures sit at $6.50 a bushel, profitable. He wants to lock in that floor without giving up the upside if wheat rallies. So he buys 2 wheat puts at the 650 strike. If wheat collapses to 550 at harvest, the puts pay out, he sells physical wheat at 550, and his effective price lands around 630 after premium. If wheat rallies to 750, puts expire worthless and he sells physical at 750, netting 730. Either way, the floor holds. The premium is the cost of certainty. Same story on the buy side. An airline expecting to buy 100,000 barrels of jet fuel 6 months out can buy WTI calls. If crude spikes, the calls offset the higher cash market bill. If crude drops, the airline eats the premium and enjoys cheap fuel. Insurance, not speculation. Speculators showed up later because the structure was already there. That's the demand side. Here's the part that actually matters for your account. SPAN margin. SPAN, Standard Portfolio Analysis of Risk, is CME's algorithm for calculating the maximum likely one-day loss across your entire futures and options portfolio under 16 specified market scenarios. The mechanism is portfolio aware. It looks at offsets. A long futures plus a long put is recognized as a synthetic call and margined accordingly, not as 2 separate positions. A defined risk vertical spread is margined at max loss minus net credit, often a small fraction of the naked equivalent. Long Long calls and puts cost only the premium, no additional margin. Compare that to Reg T on equity options. A multi-leg structure that ties up $50,000 in equity options margin can routinely require $5,000 to $10,000 in span on the futures options equivalent. For active multi-leg traders, that's the headline. That's why pros migrate to futures options once their book grows past a certain size. Capital efficiency, not flexibility. One more thing before the risks. Pricing. Options on futures use the Black 76 model, a Black-Scholes variant built for futures. The reason is mechanical. A stock has a cost of carry, interest, dividends, that has to be modeled separately. A futures price already embeds carry, so Black 76 starts from the futures price and discounts the premium at the risk-free rate. Same Greeks, same delta, gamma, theta, vega, rho, different inputs. One thing to watch. Implied vol skew differs by product. Equity index options carry a steep negative put skew. The market pays up for crash protection. Agricultural options often have flat or positive put skew. The worry there is price collapse, not spike. Read the skew before you sell premium. Now the risks. 5 worth flagging. Assignment risk on short American-style options. If the underlying breaches your strike before expiry, you can be assigned at any time, and you wake up holding a futures position you didn't plan to manage. Pin risk near expiry. If the underlying settles within a few ticks of your strike, you may not know if you were assigned until next morning. Liquidity collapse in tail strikes. A 4 delta OTM put bought for 5 ticks during low vol can balloon to an unfillable bid-ask when vol spikes, even if the position is in the money. Theta acceleration in the final week. Buying short-dated options is a brutal time bet. And remember that December 31st mark-to-market I mentioned at the start? That's the one. Section 1256 doesn't care if you close the position. Year-end P&L is realized on every open contract. If you're holding losers into year-end for a reason, that reason just got complicated. So who is this actually for? If you're already trading multi-leg stock options at scale, and you're hitting Reg T margin walls, options on futures unlock real capital efficiency, plus the Section 1256 tax treatment, plus access to commodity and rates underlines you can't easily reach through equity options. The credible US brokers are Interactive Brokers, tastytrade, TradeStation, and Schwab's Thinkorswim. Outside the US, Saxo and IBKR are realistic. Start with front-month, near-the-money options on ES, NQ, GC, or CL, the 4 most liquid products. Stay away from weeklies and FAR OTM strikes until you have fill quality experience. And if you've never been assigned an American-style option before, don't start here. Start in equity options. Take an assignment. See what it feels like on a Tuesday morning. Then come back when the mechanics are second nature. The leverage these things offer is real. So is the speed at which they punish unfamiliarity.
Options on futures reward traders who already know the mechanics. Full breakdown and link in the description.